This video is an Uncovered Japan company research report on NGK Co. Limited, ticker 5333. NGK is a century-old advanced ceramics maker whose products clean automotive exhaust, support semiconductor manufacturing, and insulate power infrastructure. Its catalyst franchise supplies cash flow, while semiconductor components supply growth. The central investment question is whether that quality still leaves enough room at a valuation that has already re-rated sharply. At the report's July 2026 reference date, NGK traded at about 20.7 times forward earnings and 2.14 times book value, with a 1.33% dividend yield. FY26 operating margin was 14.2%. NGK's product story is easier to understand by looking at the common material. Its honeycomb ceramic substrates sit inside catalytic converters and particulate filters. Its precision ceramics, including electrostatic chucks and heaters, are used inside semiconductor manufacturing equipment. It also supplies power line insulators and industrial equipment. Each application requires material recipes, tooling, and firing processes that have to work reliably under difficult conditions. That accumulated manufacturing know-how is the company's core asset. NGK grew revenue from 510.4 billion yen in FY22 to 670.1 billion yen in FY26, a 31% increase. Operating profit recovered to 95 billion yen, lifting the operating margin to 14.2%. That improvement combines the recovery in automotive catalyst demand with rapid semiconductor component growth. Net income is less useful as a guide because it was affected by the NAS battery exit charge and by gains on cross-shareholdings. For the underlying business, operating profit and cash flow are the cleaner anchors. The segment chart makes the portfolio clear. Environment, mainly automotive catalyst substrates and filters, represented 58% of sales and earned a 17.1% operating margin. Digital Society, which includes semiconductor manufacturing components, was 31% of sales with a 13.7% margin and grew 19.7% in fiscal year 2026. Energy and Industry was 11% of sales but earned only 0.3%. The catalyst business is the cash cow, semiconductors are the growth engine, and the legacy segment is a cleanup and recovery story. The moat is not a consumer brand. It is the ability to formulate and mass-produce precision ceramics, then keep customers qualified over long product cycles. A catalyst substrate must endure repeated thermal shock. A semiconductor component must hold or process wafers at demanding tolerances. Once an automaker or equipment maker qualifies a component, switching creates cost and operational risk. That supports the near-duopoly catalyst economics and sticky semiconductor relationships. It also creates a plausible launchpad for adjacent industrial markets, though adjacent opportunities still need to earn revenue. NGK's balance sheet is unusually resilient for an industrial. The equity ratio reached 65% in FY26, and the company is close to net cash. That financial capacity helps it self-fund expansion and absorb cyclical swings. The trade-off is capital efficiency. Return on equity was 7.8%, well below management's medium-term 12% target. Higher payouts, buybacks, cross-shareholding reductions, and better operating returns all matter if this balance sheet strength is to translate into a lasting valuation premium. In 2026, the company dropped insulators from its name and became simply NGK. Management calls this a third founding, an effort to position the company around semiconductors, digital infrastructure, and decarbonization. The near-term centerpiece is the Ishikawa plant, which is intended to add roughly 20% to Digital Society capacity. Longer term, management targets 100 billion yen of revenue from new businesses by 2030, including carbon capture and gas separation technologies. Those options are strategically relevant but remain pre-revenue today. The semiconductor opportunity has two sides. Digital Society is directly tied to the build-out of semiconductor capacity and benefited from AI-related demand, which is why it grew nearly 20% in FY26. The report's base case assumes growth of roughly 14 to 16% a year through FY29, with margin expansion as new capacity is utilized. But customers can also reduce inventories, and wafer fab equipment spending can turn down sharply. That makes the semiconductor cycle both the central upside driver and the most important reason earnings could disappoint. The valuation is where NGK becomes difficult. Its forward price-to-earnings multiple rose from about 7.7 times in FY22 to 20.7 times at the report date, versus a 5-year average near 12.4 times. The report estimates that the current multiple is roughly 138% of the sector average. The business has earned some re-rating through stronger semiconductor exposure, the NAS exit, and capital return changes. But a premium multiple means future returns depend on both execution and the market continuing to pay for that quality. The report's scenario analysis frames the risk-reward. Its author estimates a FY29 value of 2,948 yen in a bear case, 6,116 yen in a base case, and 9,706 yen in a bull case, against a 6,005 yen reference price. These are not price targets. The base case assumes real earnings growth and a still premium multiple, yet it only roughly matches the reference price. The bear case combines a semiconductor slowdown with a reversion toward a sector-like multiple, which is why the downside is large. NGK brings together a defensible catalyst franchise, a fast-growing semiconductor components business, and a balance sheet strong enough to fund its transition. The risks are equally visible: semiconductor cyclicality, the gradual erosion of internal combustion demand, yen sensitivity, modest current return on equity, and a valuation that already reflects a successful pivot. The useful indicators to watch are digital society growth and margins, utilization at the Ishikawa plant, progress toward the 12% ROE target, and whether the premium multiple can hold. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.